Two pressure valves opened on the same Monday. First, the war premium drained. Mediators announced a 60-day roadmap toward a final United States and Iran deal. The Treasury issued a 60-day waiver on Iranian oil sanctions, and Brent crude fell more than 2% toward the high 70s. Second, the issuance window blew wide open. SpaceX, fresh off the largest initial public offering in history, launched its first investment-grade bond, at least $20 billion, and disclosed nearly $101 billion of cash. And here is the number the whole crowd is chasing. To feed the artificial intelligence build, global power generation spending must roughly double to about $10 trillion by 2030, with energy storage expanding nearly 19 times. The binding constraint is no longer the chip. It is the electricity to run it and the grid to carry it. The crowd chases the silicon. The bottleneck is the power. So where's the edge? Not in the crowd. The durable trade is the one input the build cannot synthesize: power, and the cleanest listed embodiment of it just became the largest power producer in America. Constellation Energy closed a $22 billion acquisition to reach 55 gigawatts as the nation's largest nuclear operator. When the premium drains and the float opens, own the input the build cannot route around. This is the asymmetric. Issue 24, the opening, tech and crypto investing for thoughtful retail from an operator's lens. Issue 22 was the choke point snapping shut. Issue 23 was the leveraged crypto treasury cracking in the filings. This issue is the release, two pressure valves opening at once, and the contrast is the whole story. Here's the one-line read. Two valves opened at once. Geopolitically, a 60-day United States and Iran roadmap plus a Treasury sanctions waiver drained the war premium. Brent fell about 2.5% to roughly $79. Financially, SpaceX, public at a $135 offering and valued past $2 trillion, launched a debut $20 billion plus investment-grade bond and disclosed nearly $101 billion of cash. The issuance window thrown wide open, while the Warsh Federal Reserve still pencils a hike. The read: when the premium drains and the float opens, the durable edge is the one input the artificial intelligence build cannot synthesize: power. The cleanest listed embodiment, Constellation Energy, just became the largest power producer in America. You'll see the same labels throughout: confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. That's the discipline. Part 1, the macro regime, two openings against an unchanged Federal Reserve. The 30-second frame. 1. The Federal Reserve jaw is still locked, a hawkish hold at 3.5 to 3.75%, a dot plot that deleted the 2026 cut and penciled a hike, markets pricing a hike as soon as September, and the inflation print landing this week. 2. The choke point opened, a 60-day roadmap and a sanctions waiver drained the war premium, and Brent fell toward the high 70s. 3. The issuance window opened, a record offering chased immediately by a debut investment-grade bond and a $100 billion cash disclosure. 4. The non-yielders are macro beta, gold near $4,190, Bitcoin near $65,000. And 5. Equities sit near a record, but narrow, the S&P 500 near 7,500, with leadership concentrated in the mega-cap artificial intelligence complex. Start with the Federal Reserve, because the openings do not change it. At Chair Warsh's first meeting, the Federal Reserve held the policy rate at 3.5 to 3.75%. The dot plot removed the 2026 cut, with 9 participants now expecting at least one hike, and markets price a hike as soon as September. The dollar holds firm, and the personal consumption inflation print lands this week. A lower oil path eases one inflation input, supportive at the margin, but the Federal Reserve has explicitly told you it is not cutting into it. So the rotation that survives is a regime survivor. It does not need a rate cut to work. It needs electricity demand, which is rising regardless of the funds rate. The first opening, the choke point releases. Mediators Qatar and Pakistan announced that United States and Iranian officials agreed on a roadmap to reach a final deal within 60 days, following the June 17 memorandum. The Treasury issued a 60-day waiver on Iranian oil sanctions. Brent crude fell about 2.5% to roughly $79, with West Texas crude near $75.5. This is the release of last issue's vice. A roadmap plus a waiver is a genuine de-escalation, and oil's reaction, down, not up, is the market voting for it. The single biggest near-term disinflation lever, but it is a rocky opening. A renewed strike threat over Lebanon, Iran's stated red line, is the live spoiler. The second opening, the issuance window is wide open. SpaceX priced its offering at $135, pushing its valuation past $2 trillion, the largest in history, and then launched its first investment-grade bond of at least $20 billion to refinance the bridge loan from its acquisition of the artificial intelligence company XAI and to fund artificial intelligence infrastructure. It disclosed nearly $101 billion of cash and about $75 billion in compute agreements with Google and Anthropic. A record equity raise immediately chased by a debut blue-chip bond is the cleanest sign the primary market is open now. Issuers racing a hawkish Federal Reserve and pointing the proceeds straight at artificial intelligence infrastructure, which roots into the power bottleneck. Part 2, in focus, own the input the build cannot synthesize. Constellation Energy. The through line of both openings is the same. Capital is hunting the durable layer of the artificial intelligence build, and the binding constraint has moved from chips to power. Constellation is the cleanest listed way to own that bottleneck. It is the largest nuclear operator in the United States, and in January, it closed the roughly $22 billion acquisition of Calpine, creating the nation's largest power producer at about 55 gigawatts of capacity. The filings show a profitable, cash-generative business. In the year ended December 2025, total revenue of $25.5 billion, net income of $2.33 billion, and operating cash flow of $4.25 billion. Its data center pipeline is concrete. Contracted commitments now exceed 1,100 megawatts. These figures are pulled live from the company's filings. Now the mechanism, and it's the whole story. The most cited thesis of 2026 is that the binding artificial intelligence constraint has moved from chips to electrons. By 2030, global power generation spending must roughly double to about $10 trillion, and energy storage must expand nearly 19 times because compute demand has outrun the grid's ability to feed it. Chips sit idle without the power and interconnect to plug them in. Constellation owns the largest nuclear fleet in the country, firm, dispatchable, zero-carbon baseload, now scaled to the nation's largest power producer. It is the toll booth on electrons in a decade when electron demand is the constraint. The debate, the bull in the numbers, scarce, contracted, carbon-free baseload at the exact moment the grid is the bottleneck, the one power source that is firm, zero carbon, and effectively impossible to permit and build at speed. It is profitable and cash-generative, so it funds itself, unlike the debt-funded build-out names, and the hyperscalers are signing long-dated power agreements to lock it up. The bear. And an honest correction, the valuation has already re-rated hard on this exact narrative. So much of the thesis is in the price. The Calpine deal raised the risk profile, long-term debt more than doubled to about $17 billion, and cash was drawn down to $800 million, and integrating a large gas and geothermal fleet is non-trivial. A great asset at a crowded price with fresh leverage is a different bet than a great asset at a discount. The read, a research view, not a call. Constellation is the cleanest listed embodiment of the power is the bottleneck rotation, the input the build cannot synthesize, owned by the largest nuclear operator in the country, now the nation's largest power producer. The filings make the quality and the fresh leverage concrete. The franchise is self-funding and profitable, the opposite of the reflexive lever and the borrow-to-build name, but it is a consensus. Re-rated trade carrying new acquisition debt. What would change the read? More long-dated power contracts that lock in the baseload at premium prices, the bull, the toll booth compounds, versus a power price softening, a financing cost squeeze, or integration slippage that exposes the fresh leverage. The bear, the re-rate unwinds. The countercurrent, the issuance window points capital at the bottleneck. SpaceX's record offering plus its debut bond is the leading edge of an open window aimed squarely at artificial intelligence infrastructure. Its proceeds fund compute, and its $75 billion of Google and Anthropic agreements are compute supply, that is data centers, that is power. Morgan Stanley estimates about $570 billion of artificial intelligence-related debt issuance this year, roughly 4 times last year's pace. Every dollar of that flood ultimately needs electrons, so follow the money to its terminal use. The self-funding power layer captures the demand without carrying the issuance risk, while the borrow-to-build names carry the financing risk into a higher rate. And the thematic, the bottleneck moved from silicon to electrons. The operator consensus this week is that energy, not chips, is now the binding constraint. Chips sit idle without power and interconnect. Data center systems investment reached about $500 billion last year, heading toward $1.5 trillion by 2030, and the power to run them is the part that cannot be manufactured on an 18-month cycle. So reward the layer that is hard to build and easy to contract. Firm nuclear baseload, the gas that feeds the peakers, the grid and storage build, and the toll booths that already print cash. Be wary of what a falling cost curve or a rising rate punishes: commoditizing inference compute, the reflexive crypto lever, and the borrow-to-build that needs a rate that just rose. Part 3, the opening, own the input the build cannot synthesize. What we are watching over the next 10 days, the personal consumption inflation print this week, the swing data for the hawkish bias, the United States and Iran 60-day talks, with Lebanon and Hormuz the oil tells, new Constellation power contracts beyond the 1,100 megawatt pipeline, the SpaceX bond pricing to test how wide the window really is, Strategy's net asset value and its first semi-monthly preferred dividend on July 15th. Morgan Stanley's staked Solana and Ethereum funds, the Clarity Act on the Senate floor in its July window, the European crypto cliff on July 1st, the dollar and Federal Reserve speakers, and forward power curves which govern the entire power bottleneck thesis. And we keep score in public. Constellation Energy enters as the lead power bottleneck name, own the input the build cannot synthesize, respect the crowding, the issuance window wide open, Hormuz and oil the premium drained on the roadmap, Strategy avoid the reflexive lever, EOG the insulated barrel, Toast the self-funding compounder, Nvidia and Micron self-funding profit, Talon and EQT the power layer baseload and the fuel, Circle the settlement rails, gold, constructive, Bitcoin a liquidity tape, dated, falsifiable calls, and we grade them. So where does it land? 2 openings drain the near-term tension, a 60-day roadmap sent Brent down toward the high 70s, and a record offering plus a debut bond through the issuance window wide open. But neither moves the regime. Warsh still pencils a hike, and the inflation print lands this week. The durable rotation is toward the bottleneck the build cannot synthesize, power. ARK estimates about $10 trillion of power spending by 2030. Morgan Stanley sees $570 billion of artificial intelligence debt this year, whose physical bill is electrons, and the cleanest embodiment just became the largest power producer in America. The crowd chases the silicon and the lever. The discipline owns the electrons. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.